Good morning, everyone. My name is Christopher Vecchio, currency analyst with DailyFX. We're here to talk about the Cypriot crisis that has recently emerged the past week or so. If I could just get confirmation that we have audio and video up and running, we will get this discussion started right away. Alright, seeing that we do have audio and video, no complaints on the sound levels, so if there are, feel free to enter it into the Cover It Live chat box and we will get started. So, just a recap of what's going on. The past week has been quite tumultuous for the Eurozone as a misguided and, quite frankly, ill-constructed bailout was announced last week, okay, heading into the beginning of next. From the 15th close to the 18th open, we got news that Cyprus would require somewhere around 15 billion euros to make it through without undergoing a default, and the way that Cyprus would help contribute to this bailout would be by levying a tax against their depositors. Now, ultimately, these measures failed in the Cypriot Parliament. Not a single vote came through for this deposit levy. However, on a lack of better options, Cyprus has, in effect, agreed to so-called measures that will really negatively impact its banking structure and quite frankly hamper the economy going forward. So to back up, to put perspective how big the Cypriot financial sector was relative to GDP, in 2010, okay, assets held by Cypriot banks represented 896% of GDP. Okay, so we're talking about a banking sector that at its peak was about 9 times the size of the overall economy. So it's not surprising to see that once the legs from the financial sector were undercut following the Greek private sector bond holding write-down last year, put about a 5 billion euro hole in Cypriot banks' balance sheets. We're talking about a major problem that was created here, and quite frankly, the demise of the entire Cypriot economy. So, where are we today? Well, Cyprus has indeed agreed to bailout measures that will get them the 10 billion they need from Cyprus, plus the other funds, roughly around 5 billion euros from their deposit holders. It looks like they could be implementing a significant tax on bank accounts with more than 100,000 euros saved in them. We're talking about junior and senior bondholders taking losses as well. Okay, so who are we talking about this affecting most? Uninsured Russian and British depositors. They hold a pretty significant share of those uninsured deposits. Depositors under that 100,000 line in the sand will be protected. But this raises an important precedent, and I have to say I am not concerned with the impact that a Cypriot economic destruction will have on the broader Eurozone. Cyprus only represents 0.2% of GDP, and almost regrettably speaking, it doesn't really matter what happens to the Cyprus economy. But what does matter is the precedents that these measures now set for other bailouts going forward. And I'm hard-pressed to think that if you're a depositor in Italy or Spain, you're going to be quite comfortable with everything that's now taking place. Because what we've seen is that Europe is willing to throw under the bus savers at financial institutions, these depositors, for the sake of keeping these financial institutions alive. So, if you hold a significant portion of funds in a bank in Italy or Spain, and you see that the broader Eurozone is willing to tax you, you say you have $100,000 in a Spanish bank, or $100,000 or more in an Italian bank, and you see that Europe is, by and large, willing to tax you, take some of your money away, just because you have a lot of it, it's not likely that you're going to be willing to keep your funds in a country that is susceptible to such measures for the foreseeable future. So this brings up the very, very reasonable and very valid concern of bank runs across the continent. I don't think they're going to be as prevalent as some commentators think. I think that they're going to be muted at first. Okay, but if Italy and Spain creep towards that inevitable path of seeking a bailout on the international level, there is significant concern now that the precedent set by Cyprus, that it's okay to take away depositors' funds to save the financial institutions, then we're looking at a whole new can of worms that hasn't even been touched yet. Alright? So now where do we go from here? In the last 2 days, Friday and today, there have been reports that Cyprus would reach an agreement. Unsurprisingly, the euro is trading higher, not for any particular reason other than uncertainty being removed. Last week, a bit of that uncertainty revolving around where Cyprus would get the money from provoked a sell-off, just on the basis that maybe we could see a smaller eurozone. Who knows what would happen with Cypriot Cyprus economy given a potential exit. With those concerns now removed, we're kind of back to square one we were on the 15th when markets closed, trading up towards 130.75. All right, we traded up to 130.40 today, right, just about there. 130.51 actually was the high. We have that 21 EMA at 130.42. We bounced right off of it, and this is a level that we've actually held. Haven't had a close above it since the 13th of February, and since we closed below it on the 14th, we have not seen a daily close above. So last few tests of 21 EMA have produced further selling pressure. We see that once again from the 15th. We see a test on the 25th, again 20th and 19th. So an important level here that was respected initially. We'll see what happens here. We're talking about a move off of the February 1st and March 15th highs. That's coming in right around 129.90 today, considering the high came in at 130.11 on Friday. To split the baby here, I'm talking about a close above 130 on the head would be quite significant for bulls and bears today. We're going to see how that pans out. But if that does break, we do see that the RSI momentum downturn from the 1st and 15th highs, that's already been broken. So even if price does not settle above 130, we do see that there's scope for continuation of the rally. Maybe we're going to see some further congestion first, but price has now settled above a momentum level that's really been keeping the pair intact for now, the downtrend intact for now. But rounding back to the situation, where does this put us? Okay, this reaction today, I have to say, it reminds me of what happened in last June. Okay, when we had the Spanish bailout come to fruition, or the Bankia help, the recapitalization of the Spanish banks. All right, and what happened there? Well, we actually saw the market trade up from the 15th to the 18th, just significantly higher, right? And then we fall back right away, and we actually don't encroach those highs again for another 3 months, essentially, until the 7th of September. So seeing the market trade up higher today initially is not surprising. But now I'm partial to think that, okay, the market's had time to digest the news. We've run into a significant level of technical resistance. It's pretty clear that there are now wider concerns that have been raised. What is going to transpire down the road should Italy or Spain need help? And by all indications, the market is not impressed. They are concerned about what would be happening down the road. And quite frankly, if those concerns were unwarranted, I think we'd be seeing the euro-dollar trade much higher. At the end of the day, price is what pays, opinions don't. And what we're seeing here is a euro-dollar that closed on Friday at 129.92, and we're trading at 192.98, 50 pips off of the high, essentially 50 pips off the low. So we've traced half of the daily rally on the back of this better than expected, so to speak, measure. Now, there's a lot of talk about what Germany's position on this is, and quite frankly, we need to understand the mindset of Germany's leader, Angela Merkel, with respect to this whole crisis. And from the get-go, her position has been increasingly clear. She is going to do whatever it takes to keep her image intact among the German electorate. And she does have an election coming up in September, so to see her take a stance that says we are going to spend as little money as possible, approximately 2/3 of the overall cost of the bailout, and force Cypriot depositors to endure the rest, shows that she's being firm, and that's something that her electorate will like to see. So the German position here, let's be clear, is motivated by nothing short of political motivations, political intentions that are going on behind the scenes. And is that good for Europe? Maybe not at present time. Is it good for Merkel and her election chances? Absolutely. And between now and September, we have to keep in mind that that will be a guiding force for whatever measures that are taken, whatever assistance Germany is willing to extend to others in the near term. Now, there's some other big ramifications here. What could be happening with some of the other major currencies as a result of this crisis? I think the big one to look for would be pound-dollar, actually. Pound-dollar is quite interesting because we have seen the pound take on a hybrid role as an alternative safe haven in the Eurozone crisis when the situation really begins to hit the fan here. Why is that? Well, the dollar has obviously some appeal to it on a broader level, but the pound is the regional safe haven now that the Swiss franc has been relegated to the sidelines. Swiss franc's been relegated to the sidelines since really I would say early August 2011. Of course, the SNB implemented the 120 euro Swiss floor on September 6, 2011. But that's when Vice President, or then Vice President, who is now the President of the SNB, Thomas Jordan, said that a floor would be possible. And at that time, it was really a capital control on the Swiss franc. Investors can no longer use it as a hedge against Eurozone sovereign crisis conditions arising, and so now the pound, as the next best regional currency, maybe actually after the Nordic currencies, it really serves as that role because of London's position as a global financial center. So the pound dollar has risen here in what has been so far a three-wave rally off the low we saw on the 12th. It's important to note that we're only 2 weeks away from the low, and everyone's getting so excited about this 400 pip rally or so off the low in the sterling, and I'm looking at the big picture here. We're still, over 1,000 pips down, 1,100 pips down from the highs we set on January 2nd, 2013, the first trading day of the year. All right, so big picture is that this remains much, much lower. All right, pound dollar outlook is neutral for this coming week because it could see some flows away from Cyprus now. However, I think that the uptick that we've seen after the BOE and UK budget is now pretty much done. So, where does this leave us going forward? I think that we're now going to see a pullback in risk. Okay, I think that liquidity is still flowing, so that helps the commodity currencies, which have seen about a better data recently. We have to consider the fact that a recently dovish RBA, when I say recently, over the past 6 months or so, has shifted its tune to something more neutral. Housing has outperformed, labor has outperformed, inflation has outperformed. Aussie dollar sitting near the highs today, 104.75. Okay, Kiwi dollar, similar thing. Stocks moving up towards significant levels as well. S&P 500 fair value, fresh yearly highs today, 1566.1. Just about 2.5 handles lower off the highs there. All right, but now we're talking about broad Eurozone concerns that could lead to a return of the crisis. Certainly after the Spanish bank recapitalization last June, okay, there was some near-term relief, maybe a few days, before we slid back towards those all-time, those 2-year lows, okay, in the euro dollar at 120.41. So I'd be looking lower in the euro right now. I think that this was a bit of just a relief short covering, shook out those weak shorts. All right, now that everyone is pretty much on the same page that this is not a good measure for broader Eurozone, stability in terms of sentiment. What do investors feel? Will this prevent capital flight? I think there needs to be a significant reevaluation of whether or not it's safe to keep your capital in Europe, and acting under the assumption that these austerity measures are entirely contingent on growth. Okay, let me backtrack there for a second. Austerity only works insofar as if the revenue stream, the revenue side of the equation for this budget consolidation holds up, okay? And in a lot of these countries, the reason why these budget measures have been falling short of their targets is because austerity in an economy that is already facing significant pressure, okay, austerity pinches consumers' pockets more. Okay, this has a multiplier effect where it's not a one-for-one, taxes go up by, say, 1%, so consumers spend 1% less. Taxes go up by 1%, consumers are spending 1.5% less. Okay, so now all of a sudden, consumers are spending less, businesses are paying less, unemployment is going up by more than expected. Taxes are falling short of their projected targets, so more austerity needs to be brought forward. So as this economic struggle continues in the region, alright, we need to consider the fact that austerity will have to continue because of this snowball impact. Alright, so now we're at the point where we're seeing an accelerated effort, deposit tax now, to kind of cover these budget deficits. I think we're going to continue to shun the European consumer, and these budget consolidation efforts will continue to fail. So as growth in the region continues to struggle, we're now on an accelerated path towards that struggle. I think we need to be selling the euro just on the pure fundamental basis of diverging economics between the US and Europe. And this was something I expected to really take hold in the second half of the year. I have to be honest, I was caught a little off guard by the fact that the euro rally in the beginning of the year only lasted until 137.10. Okay, I thought that it could continue all the way higher, perhaps even towards levels above 140. Okay, we really see that once we cleared, once we got above, this 135 figure, there's not much in terms of significant resistance. Maybe we're talking about 138.50. Alright, we have 138.50 here, February 2011, and then go back to July 2011. Former resistance becomes support. Right, but outside of that, mid 138, 139 level, we're not looking at anything up towards, 142. All right, so I thought there could have been easily a scope for a further run, but the return of those Italian, Spanish, and Cypriot political concerns really dented hope in the euro-dollar now, and that timeline for euro-dollar weakness has really accelerated to something more near-term. Alright, so I'm thinking that we could finish the first quarter, which is again at the end of the week, essentially right around this 130 figure. I would remain bearish the euro-dollar should euro-dollar price action close the coming week below 130.85. Alright, this trend line that's really kept price capped. Alright, in March, since those late February, swing highs here, on the 28th coming in like 130.65, 131.65, 131.30, 131.10, and now the next interval, if you will, this ratio interval would be 130.85. So if we hold below that this week, today's level, okay, then I suggest that we could be seeing price really fail despite an increase in momentum, and that could be offering up a nice new opportunity to get short. I really like the US dollar going forward. We have seen a bit of a technical pullback. A technical pullback is not that surprising considering where we've come from. If we take a look at the 2011 and 2012 lows, okay, I drew this parallel out to the highs we saw in November 2011. We know that this is the important respected level because we don't have weekly closes above it, and price has since returned to this and fallen quite precipitously. This is what we expect. If this is indeed corrective, okay, the first corrective wave would need to be in a 5-wave motion. Alright, corrective waves, if we're seeing that we're due for a true correction, we would want to see impulse off the top for that A leg. So A would be impulse, B would be a 3-wave correction higher, and then C would be another 5. So now that we're holding at least this trend here, okay, the more recent rally, I would not be surprised to see a rebound in the buck before ultimately a test of, say, 10,400. We're at 10,430 right now, but 10,400 flat, okay, would be a nice test of this ascending trend line off the December 2012 and January 2013 lows, okay, and then we could be geared up for another move higher. Alright, would definitely make sense in scope of everything. That could be led by dollar yen, in my opinion. Dollar yen looks like it's coming into a buy shortly. 93.60 would be ideal. I'm not sure if we'll get there. We're trading back at that 21 EMA. Has been a magnet for price since mid-November. We see that we only had one true big test of it, and that came in mid to late February. Right, fell below it on the Italian elections. Within 3 days, we were back trading above it, and now we are testing it once more. Alright, so I would like dollar yen higher as well. Maybe that drives US dollar, but euro dollar, really continuing to slide throughout this conversation. Market's still pulling back, and now we're below Friday's close again. And we're below that crucial trend line that I mentioned off the February 1st and March 13th highs. So it's very possible at this point in time that this enthusiasm over the deal itself has been rejected, and every time we have one of these measures brought forth, something always comes up that derails sentiment. And so now, seeing news across the headlines, Vladimir Putin, Russian president, orders the government to discuss a restructuring of the Cypriot loans. Obviously, this is raising a question about what's Russia's role going to be. Russia has an interesting role in this crisis, and this is something I didn't bring up before because I don't like to pander to conspiracy theories. But I think there's a grain of truth with this. Cyprus has very loose capital controls. They did actually up until this weekend. They also have a very favorable tax policy. So, given the proximity of Cyprus to Russia, Cyprus has served as a bit of an offshore tax haven, similar to how the Cayman Islands or other Caribbean islands serve as a tax haven for the United States, or how Switzerland serves as a tax haven for Europe. Cyprus serves that role for Russia, so there's a lot of funds from Russia there. Obviously, there's Russian interest then in seeing that any Cypriot bailout falls in line with what is favorable for Russian citizens, and so if there's a deposit tax there, Russia is likely to impact some retaliatory measure that strikes back at Europe, if you will. So Russia should not be ignored during this. Again, Russia did give Cyprus a 5 billion euro loan last mid-year, I believe it was June or July. So to have Russia as part of the conversation is very key to the balance of Cypriot in the Eurozone going forward. I see some questions here, and a lot of them are really concerned with the sentiment. I think this one sums it up best. Regardless of the outcome of Cyprus, given the situation in Europe, shouldn't the euro nosedive? Is the situation being played down by some kind of intervention? And I agree that there is some sort of intervention going on. It is going on insofar as the ECB is offering a significant safety net with its OMT program, okay, the outright monetary transactions, essentially capping Italian and Spanish bond yields. All right, we've seen that the 2-year and 10-year notes, those yields have slid significantly since last July. We're talking about Italian and Spanish yields that were trading up near 7% on the 10-year range, even in the case of Italy and Spain, moving up of 5% on the 2-year notes. Absolutely unbelievable. And since then, they have plummeted right back to earth. So the euro is supported by those lower yields, because it says that there is some financial risk or credit risk that has been removed from the region. So without the ECB, the day that Mario Draghi said that he would do whatever it takes to save the euro was July 24th, 2012. All right? Or July 25th, 2012. And so we see here that the yearly low and really the crisis low is set after he pledged to do whatever it takes. If you remove that pledge and you remove the OMT program that was announced in September, I think the euro is easily in the mid 10s now. In fact, without doubt, I would say that the euro is trading probably closer to 115 now. Yes, the QE3 uptick helped, right? The Fed implementing QE3 back in September, expanding it in December, the LTR repayments, that all helped, okay? But the LTR repayment window, I would say only produced 500 pips or so. I think without the UMT, we're talking about, you got to completely remove the July to September rally out of the equation. That's, 1,100 pips. I'm not saying we'd be 1,100 pips lower, but I'd be suggesting that we would be significantly lower. It's obviously not a one-for-one trade-off, but without the UMT, sentiment is completely different about Europe, about S&P, about whether or not the Fed's going to leave. Really, it's a complete game changer. We're looking at a very different price chart. Nothing would look the same here. So overall, I think you got to be selling euro rallies. I think euro dollar is very favorable. I think that the pound could see some elevated flows as it has from that. I like the pound until say 152.75 or 152.85 all the way up to 153.75. It's this Fibonacci sandwich, I like to call it. We see that each 100% extension creates a slice of bread, whatever, where the meat of the sandwich would be the sell region. Okay. We're talking about the 12th low, 15th high, down to the 20th swing. Okay, this flag here that we've been watching, if you read my morning slices report, okay, that's the top side rail. We see the bottom side rail would be the flagpole, if you will. So I think that there's room for pound dollar to climb. I think if you go over to euro pound, then we're looking at a potential euro pound trade that would suggest that this is due for a pullback as well. I think when we look at the charts here, and this is actually an incorrect pattern that I'm watching. This is actually what I've been watching recently. This rising wedge that gave way. Okay, rising wedges like this are bearish patterns. Alright, often signs of exhaustion. Now it looks like we're due for a pullback. Certainly, I think that we must respect at least the 84.50 level to the downside. If we get a weekly close below 84.50, I think that in terms of this bigger move, when the euro pound trade really took off, we need to be respecting the move off of the January or the yearly low. All right, and we see here that 84.50 also the February swing low, pretty significant. Okay. But I think that we could be looking lower towards 83.63 and maybe even 82.65 should 84.50 give way. I like euro pound lower now at this point in time. I think the pound has a lot of weakness baked into it. I think the pound will continue to lose value over the course of the year against the dollar. I have pound dollar trading to as low as 142.50 this year before a potential rebound. But I think the euro pound is favorable now for further losses because the eurozone crisis is coming back into the picture. And as we've seen previously, as throughout 2012, the eurozone crisis really weighed on euro pound. We're talking about a high near 90 during July 2011. We're talking about a low near 77.50 in July 2012. Pretty significant move. Pound could be bolstered by that. As the euro pound flows accelerate. And again, it's all about the Swiss franc when we talk about the euro pound, and that kind of seems out of whack, but the Swiss franc is null and void as a safe haven against the euro. Yes, euro Swiss has risen, which means that euro Swiss could fall back a little bit, but euro pound is where you want to be at because it's more liquid, less intervention likely, and if anything, liquidity is not going to be a problem because the BOE continues to prime the pump. Alright, so it's been a half an hour. This was just supposed to be a primer on what's going on in Cyprus, a discussion of the measures, what could happen going forward, a more of a fundamental breakdown of the situation here. So I hope this quick half an hour review of what's been going with Cyprus makes the situation a little more clear. I really, truly don't think we should discount the impact that this deposit levy will have on investor sentiment in Italy or Spain. It is a very, very, very serious matter. Once trust in financial markets is broken, it's hard to regain. We saw what happened in 2008 and 2009. Although the economy, in the United States at least, had bottomed out for a while there. We do see that stocks and financial markets struggled for a number of years. All right, financial sector still under attack. From a popular point of view, on a social level, to on a political level here in the United States, understandably so. Europe is not immune to that just because of the ECB. If the ECB loses grip on Italian and Spanish bond yields, then we're looking at a very serious situation. Again, this week, I'd be watching for a close under 130.85 in the euro dollar. Today really would be 130, the level line in the sand. I really like that price action off that 21 EMA, and we have to see what happens when Cypriot banks open tomorrow. Bank run is very possible. We really should not discount a very short, mildish, bullish reaction here, as we saw with Spain and the Spanish bank recapitalization in June last year. We had a few days of bullish price action before the euro continued to fresh yearly lows. So, fresh yearly lows are only 150 pips or so away. Okay, closer than the yearly highs, near 137 at this point in time. The U.S. economy is improving, Europe is getting worse, and now we have this very significant sentiment block in place. I would be very weary of anything that's going on right now. And now's the time to be nimble. Alright, so hopefully everyone, this helped out. This will be posted to dailyfx.com in the archived version. As always, I will host my Tuesday morning webinar, Trading Q&A, more of a technical discussion rather than the fundamentals, as was today. That takes place Tuesday here back in DailyFX Plus at 7:15 Eastern. That's 11:15 GMT. You can always reach me at CVecchio FX. That's on Stock, Twitch, Twitter, and the DailyFX real-time newsfeed. CVecchio at dailyfx.com. I've been a little slow with responding to some of those emails about the book list and the 821 moving average strategy, which is currently just in neutral right now. That price action is consolidated in many of the majors the past several weeks. I'm going to give a bigger review of that tomorrow. Tomorrow I will be sending out those emails. I do apologize if you've emailed me over the past week or two about them, and I have not. I've been waiting for the inflow to come in so I can just take care of it in one fell swoop. We've reached the threshold now, so those emails will be going out shortly. Other than that, hope everyone has a good day trading, and good luck. Not much on the U.S. economic docket for today. Only a Chicago index due out. Outside of that, we're really looking forward to data tomorrow and Thursday between durable goods and U.S. GDP. Final revision for the fourth quarter. All right. Hope everyone has a good day. And again, I'll be back tomorrow, 7:15 Eastern, to talk technical trade setups here in DailyFX Plus.